Hello. Justin with Deep Dive Stocks here, and today we're going to be doing an overview of the first part of what is liquidity. Everyone talks about it. It's a word everyone throws around, but you might be surprised to learn that there aren't actually any robust frameworks for what liquidity is at least that I've been able to find. If you have some, put them in the comments below. Send me an email. But there really isn't a framework of liquidity that helps describe what it is, what it's doing, where it comes from, who's taking it, and why we need it. It seems to be this ethereal idea in the market that liquidity is just the thing that needs to be present for something to happen. Sometimes that means if a position needs to be exited, then I might be concerned if there's liquidity for me to, say, sell my shares. Sometimes I might be concerned where liquidity is if instead I am being short squeezed or if I'm an options dealer. Yet it's difficult, if not impossible, to find a framework that can cover all of the various aspects of the market into a comprehensive singular idea. And that's what I'm going to introduce to you today. Deep Dive Stocks, Theory of Liquidity. Why are you talking to me? So let's get started. The first part we have to ask sort of is, because we know that liquidity is somehow related to the market. And so let's start our adventure. Let me make sure also, as usual, we have behind us, I just want to make sure it's automatic so it adjusts. We have Bitcoin on the 30, just so we can keep an eye on LDPS as it does its thing. And I put it on the 30 seconds just so it could be a little exciting. So we know that liquidity deals with the market. Cool. What's the market? What is the market doing? What are we doing here? And for this, we're going to do, and forewarning, we're going to use math notation, but this video is really just about getting an overview of how to start thinking about liquidity in a robust and internally consistent way. So we're not going to dive too deep into the actual underlying equations, but we are going to express these ideas in a bit of a mathematical format. But I hope that as I bring us through this journey, that it won't be too scary and too unwieldy. So keeping that in mind. So the idea is, what is then the market? How can we define the market in a way that it makes sense no matter if we're talking about futures, equities, swaps, or even if we're talking about going to your local village's farmer's market, right? The idea of all of these markets, what are the common themes we can distill from them? Because those should be then the things that liquidity is associated with, since liquidity should be present in every market at some point or another. So let's start with trying to figure out what is the market. And lemma, and this is where the math comes in. So lemma 1 from Deep Dive Stocks says that the market is a tool to facilitate favorable speculative transactions. And so this covers all markets. The idea is that people come to the market to get favorable speculative transactions. And the idea is that if I am selling apples and I go to the farmer's market, I want to sell them at a favorable price, right? I need to make a profit. And I'm inherently assuming that the value of the apple here is greater than the value at my farm. So there's this element of speculation. And we can take this even further because then we know if liquidity is then associated with being favorable, speculative transactions, we can start to, maybe we can define, I'm trying to balance like not taking too long to write, but having good handwriting. But we can now start teasing this out some more. What does it mean to be favorable? What does it mean to be speculative? What does it mean to be transactions? Right? Because we know that these tools under this theory, or these aspects of what a market is, are what liquidity is associated with. So what does it mean if a transaction is favorable? Well, then that means probably something along the lines of it's probably opportunistic for the trader. So there's a favorable time to trade. There's probably so I can, if it's the maximal favorable market for me as an individual trader, is one in which I can enter into the market whenever I want, and I can transact what I need when I want, right? So there's this favorable time component. There's probably minimal overhead. So I don't have to jump through a lot of hoops. There's not a lot of obligations to me trading. So I can trade when I want, and the act of not trading or even of trading doesn't incur too much downside, such that the value of the trade ultimately ends up favorable. And then I can probably trade the amount that I want, when I want. So there's no overhead to me holding a position or trading a position. I can enter and exit that position whenever I want. And I can enter and exit any size that I want. So what about speculative? What does it mean to be speculative? What's a favorable speculative transaction? Well, this means that there's probably a preferred price. Right? And that's basically it. There is overhead, but it's already kind of in the favorable. But the idea is like, if it's going, if there's a cost to carry for a particular position, then I'm probably always going to be interested in knowing if the current cost to carry or the projected cost to carry is going to be able to cover, or if it's going to detract from the future value of this position. And so with these two main categories of what the market is doing, we can start to introduce some math talk. For instance, suppose we say then that we call the opportunistic timing I just really want to make sure I don't check in my notes. Oh, real quick. So, see, good notes. So now that we have these ideas of favorability and speculative, the question becomes, well, what does all that tell us? Well, it kind of tells us that a trader's need can be defined as some combination of favorability and speculation. Right? And if we want to get a little technical, we can see that it's really about 1 over favorability. So the more favorable trading becomes, the less the trader's need is, times speculation. But this is kind of an intermediate step that you don't really got to pay attention to, but for completeness. So we're starting to carve out this idea that liquidity is associated with some need. And that need is a combination of favorability and speculation. And an interesting way of an interesting consequence of framing it this way is that we can get a little bit more robust. And instead of just this general idea of a trader's need, let's say that there's a trading pressure. Such that when the trading pressure increases, this means that the trader need is increasing. And if the trading pressure is decreasing, then the trader's need to transact is also decreasing. And the cool thing is we've already defined these trading needs above. So we had this idea of opportunistic timing. And let's call that K. We said that there was a component of minimal overhead, right? And we're also actually going to put that in K. We said that there was a amount for favorability, right? I want to be able to transact as much as I have or need when I want. And we can call that N. So K is coefficient of urgency. N is the coefficient of demand. So we had the opportunistic overhead, the amount, and then the last thing we had was the desired spot. So I'm just super paranoid that sometimes my brain will use words, but in these types of videos, I'm trying to be a little bit more making sure I'm using the same words, right? So we had the opportunistic favorable time and the overhead, which was K. We had the amount, which was N. And we had that preferred price, which we're going to do now. And that we're going to call gamma. And there's also the preferred time, right? I think we mentioned it kind of like when. Opportunistic timing. The opportunistic timing is admittedly split, but we can call this T. And this is just the expected duration of trade or the time of obligation. And that's exactly what that is. Coefficient of So we have, in sum, we've been able to carve out this idea that liquidity is associated with the market, which is associated with the trader. And the trader has a trading pressure that is defined by K, the coefficient of urgency, how urgent it is to trade for that trader, N, the coefficient of demand, how much that trader needs to trade, and gamma, which is the, did I actually even give you gamma? Yeah, preferred spot. So this is the coefficient of liquidity. In gamma, the coefficient of liquidity, which helps describe the actual transactions and how they can occur in those moments. And then we said that there's also the coefficient of obligation. So for instance, if I'm an options dealer and I have to transact before, my risk compliance becomes non-compliant, that's an urgency, that's a demand. I need to make something happen. And so with these puzzles, we can even go a step further and start carving out their actual relationships in a way like this. We can say that the pressure of a trader to trade is defined by their coefficient of urgency times their coefficient of demand times their coefficient of liquidity divided by the coefficient of obligation, or the coefficient of like the expected duration of the trade. And what we can see from this is that if the coefficient of obligation, the coefficient of urgency increases, then my trading pressure increases. So it becomes, if I have more urgency to trade, that it represents as an increase in my trading pressure. And conversely, if my coefficient of demand increases, then my trading pressure increases. I have more demand to trade. I have more things that I need to get done in the market. And conversely, if it becomes more difficult to actually transact, then my trading pressure increases. But we see if I get a increase in the time I'm allowed to be in this trade, then my trading pressure decreases. And it's a pretty cool way of describing things, because now all we need to do is say, well, then liquidity must be associated with K, N, and pi, or gamma. Not T, because T is more so the duration of the trade, right? You can't change time, even liquidity. And what we find is we can say then that liquidity is equal to how the change in the total market pressure is. And the total market pressure is defined as the sum of all of those trading pressures. So if we add up everyone in the market's trading pressure, and it modulated a little bit by the market efficiency. So this means we can define liquidity as the change in the total market pressure, where when liquidity is positive, this means that the total market pressure is decreasing. People are getting, as a whole, more and more and more favorable transactions. But if liquidity is decreasing, then we can say that the overall market pressure is increasing. So each individual trader is having a greater and greater time, or more difficult time, in fulfilling either one of their coefficients: demand, urgency, obligation, liquidity. And yeah, that's where we're going to leave today, I think. Because I always want to go deeper, but I'm going to leave it there so that we can digest a little bit. We're going to dig through a bit more in what these coefficients actually, how we can describe these coefficients specifically. But if we were to just do a quick recap, we said that liquidity, well, no, let's go through we said the market was associated with favorable, speculative transactions. We defined favorable and speculative as being some components of being able to trade when you need to, being able to trade as much as you want, and actually having transactions, as well as the time you have to trade. We then said we can pile all that together and we can describe a trader's trading pressure as these values. And then from there, we can say that the total market pressure is defined as the market's efficiency times the sum of those trading pressures. And then from there, we said that liquidity then is simply the expression of the change in that market pressure, such that when liquidity is positive, we can say that the market pressure is decreasing. So liquidity is becoming abundant. And when liquidity is decreasing, we can describe that as a increase in that total market pressure. And that's liquidity. So now the name of the game just becomes, well, how do we define the coefficients of urgent, amount, transaction, time? And then how do those increase and decrease on their own? So what factors play into if a trader's urgency increases? And then from there, it'll be an easy step into looking at, well, then how does the market alleviate these pressures? So if a trader's urgency increases, what does that mean for the total environment, for the total liquidity environment? Just a little sneak peek for a motivating example as to why the going through all that, what might seem very tedious, is beneficial, is that we arrive on certain truths such as the law of asymmetric demand. This is just a little motivating example to see where we're going to go. And the idea is that a trader's trading pressure, like we said, is dependent on their urgency, the amount that they have to trade, their ability to trade, and the time they have to trade. But like we said, there's the market's liquidity, what the market can interact with, doesn't include all those components. Liquidity really only deals with, as it turns out, the coefficient of liquidity. Liquidity can't change, so liquidity has no influence on a trader's urgency. Right? So for instance, if I'm in a trade and all of a sudden I get margin called and my urgency skyrockets, liquidity can't help with that. Liquidity can help transact, but it has no ability to modulate what the deal you have between you and your broker for the margin you're using. That's not liquidity's concern. And so we get this asymmetric pull and tug in the market where the liquidity demands where liquidity demands are greater than the liquidity supplies, like where the liquidity supply can go. And so you have this asymmetric law of liquidity in the market. You can demand more from liquidity in different aspects of an individual trader and then in the sum of traders than how liquidity can provide a solution towards the lowering of those trading pressures. And an interesting consequence of this is you get this asymmetric magnitude of response. So for instance, suppose my trading pressure is increasing because my urgency has skyrocketed and my time that I have left to trade plummets. Well, the magnitude of these changes has to equal the magnitude of liquidity. And since liquidity can only deal with the coefficient of liquidity, this means that the change in the coefficient of liquidity is equal or is a component of the change in two other variables. So the magnitude has to be shared, but these will always be greater in part. Right? There's always more things that can demand liquidity from the market than the way that liquidity can interact in response. And so those create some interesting, as we dig through the definitions of these coefficients a little bit more, certain things are going to start making sense, but might be a little paradoxical. So for instance, if I'm being short squeezed, and my demand is skyrocketing, the amount of time that I have is dropping like a lead weight, the amount of shares isn't going down because I can't transact. All of this is going to have to be balanced by a change in gamma. Let me rewrite that. So the only way that liquidity is going to be able to come in and lower this trading pressure is by modulating the liquidity, or the coefficient of liquidity, which, I guess we can continue with the motivating example, is defined as the trading pressure, or the trading friction, times the number of trades that need to be sold, times the magnitude difference between the current spot and the desired spot. Oh, times the spread. So let's rewrite this. So this will be times the spread, times the trading friction, the number of shares, and the magnitude difference between the desired spot and current spot. And so all of these forces exterior to the market are going to be balanced and channeled through the market through the spread and through spot and through traded volume. And so when we see these substantial moves in spot or the spread, or when strange volume profiles come through, it's likely a balance that's attempting to happen, such that the magnitude of these changes have to offset the magnitude of those individual influences that are exterior to the market. And so yeah, you get sometimes really big, volatile, liquid environments. For instance, a short squeeze is liquidity entering. Most people think that, the idea is that short squeezes are because there is no liquidity. And that might be true, sure. But the real, more comprehensive approach is to understand that it's about liquidity entering the market to satisfy a trader's trading pressure. And there's only a certain number of ways that liquidity can alleviate the trader's trading pressure. And one of those happens to be moving the spot. Because if you need to trade, then you need the spread to decrease. But if you also need your overall delta gamma to decrease so that you can decrease your trading pressure, this means there's a relationship between the spread and the spread of the bid and the ask, and then the spread of spot between current and expected. And so if you want to drastically decrease, you need to transact, you're going to need to increase your movement such that at least this relationship is held. And so the big spot moves during these really exciting events is liquidity working to just balance out those forces. So I'm going to leave it here, even though I said that last time, and then I said we were going to do a quick review, and then we went into a review and then did more. That's why you got to stop me from talking. But that is the overview of part 1 for Deep Dive Stocks Theory on Liquidity. Next time, we're going to define those coefficients. And with this framework, we're going to define those organic, eager, and aggressive parties. We'll define what it means to be a liquidity supplier or a liquidity taker. And then we're going to look more into the relationship between liquidity's dependence on gamma and how that affects the overall trading pressure, which is dependent on K and T gamma. So that law of asymmetry. And there's a few more laws. So then we also have to define the law of the conservation of liquidity, which says that the sum of liquidity is 0. We also have to do, so we did the asymmetrical law, the law of, I guess, don't stop, I'm going to stop. So those are just motivating examples of what we're going to be doing later on. So, okay guys, that is it. That's all I have for you guys for real this time. Thanks for joining. If you like these more in-depth, thorough, slightly slower videos, let me know. So far the feedback has been good, so if you don't agree with that, you need to let me know, or else I'm just going to keep doing these. And there's no use me doing things that you don't like. Defeats the whole purpose. So, alright, I'm going to leave it there. Enjoy, happy trading, and I will see you guys next time. Adios.